I'm Sonny Aguilera, Sales Manager, American Pacific Mortgage, out of the Stockton, California office. That's Brookside, for those who know. And we have our associate Kenny Bergman here joining us, and thank you very much for attending. Thank you all joining online. I want to talk a little Lending 101, talk about homebuyer programs, the dream for all that's coming, and things like that. So as we begin, I just want to thank you very much for your time. I've been in the lending business for 30 years now. Yeah, I've survived, thank God, relatively unscathed. Less hair, but you know, hey, that happens, right? But we're here today to talk a little bit about homebuyer programs and to help everybody understand the process a little bit better. So let's begin. So at American Pacific Mortgage, our goal is to bring people home. We specialize in a myriad of first-time homebuyer programs. We are also integrated in many counties and cities with their municipality programs as well, whether it's below market housing, low income. We are affiliated with hundreds of entities across the state to help those who cannot afford a home get into a home and reach the American dream. I myself am a preferred Cal HFA loan officer. I'm approved in 7 counties here in the state and obviously approved to do Cal HFA throughout the state of California. That's just one program I'm approved in. I'm also approved in with House Keys, City of San Francisco, City of San Diego, County of San Diego, you name it, pretty much we're there. But the main goal is is getting people who don't have the advantage of getting gift funds from parents or having 20% down, helping those people get into a home. And that's exactly what we do. Some of you may not know this, but I worked at American Pacific from 2008 to 2014. And we came back to 8 p.m. here back in 2022. It's been a good ride home. So our agenda, who we are and what we do. Well, again, we specialize in helping people get into homes. Our first-time home buyer is our goal target because we want to help families build generational wealth through home ownership. We talk about buying versus renting. Now, some of you may say, well, it's cheaper to rent. That's true. But let's do the simple math. If you're paying a landlord $2,000 a month in rent and you rent for 5 years, that's 60 payments of $2,000 a month. That's $120,000 in 5 years you've given that landlord. In turn, your house could have appreciated by that same amount in 5 years. So that's a $240,000 swing just by making that purchase. So you do the math yourself, but buying a home is definitely a sound thing to do in any market, that is. Okay. Now, at American Pacific, we are a banker. Okay, we are a mortgage bank, and what that means is that all our underwriting is done in-house. We do everything in-house, so we don't send anything out. Things don't get stuck. We have control. We can request rushes. We have a lot more flexibility because we do everything in-house. We have relationships with our staff, with our underwriters, with the people who draw your loan documents and fund your loans. So that all makes a tangible difference when it comes to financing, especially when, and to be honest with you, not every loan is easy. Trust me, some of them are really, really difficult. But when you have people who are on the same team working for the same goal, it really does make a difference. And again, the advantages of buying versus renting, I just said it. But the other thing that you have to remember too is that it's a chance for your family to have stability. As a child, I moved a lot, probably 20 times in my lifetime. So having a stable home and a place that you as a child or as a teenager or even as an adult can call home and know that's going to be yours for the rest of your life is extremely important and very satisfying. That's one of the benefits of it. The other one is you get a great tax benefit from owning a home. And you also gain equity and gain wealth through equity. People often use their homes to help fund college funds. They often pull money out to buy another property. Maybe they want to do an Airbnb. Maybe they want to start a business. So using your home can be like your little piggy bank, and you can use it for those things that can help you get further in life that you never thought you could. So the anatomy of a mortgage payment, this shows you what a mortgage payment consists of. The first line is principal and interest, so that's what your total payment includes. So when somebody asks me, what is my mortgage payment? That is what your true actual mortgage payment is. Every house payment, every property you buy includes property taxes. So depending on the area, it may be higher than 130, which pretty much that's higher. Yeah, that's a very low number for California. But Every home has property taxes. You will have to pay that. And depending on how much you put down, you can include it with your payment or you can pay it on your own. And insurance, this is called hazard insurance or homeowner insurance. Whenever you finance a property, it is mandatory that you have some sort of hazard or fire insurance with the minimal coverages required to be put in place for you to purchase a home. Now PMI, okay? Now people ask what PMI is. PMI is what they call private mortgage insurance. It is issued on any loan that you do not put 20% down on, or any FHA loan, okay? Now, if you are a conventional loan buyer, for example, and you have 10% down, there are no PMI options available. You have to have a really good credit score and your file has to be really solid, but sometimes the cost is very minimal to buy it out. And some people do take that option, and we do offer it to people who we do feel qualify for that option very well. Now, what types of loans are there? Well, there's a conventional loan. Now, a conventional loan, when you're purchasing a home, a conventional loan is the most desired loan program that sellers want to see. Sellers feel that if you are able to obtain conventional financing, that means you're a very strong borrower. That means you have a really good credit, and that means you have the funds in which to make this transaction. They feel that you are very low risk, and when it comes on the level of the totem pole in terms of offers, they're going to look at your offer first. And then you have government-backed loans, which are FHA, which is the most popular. That's through the Federal Housing Authority. VA, which is set up for veterans, that allows them to do 100% financing for veterans or their surviving spouse. And USDA, which is allocated to rural areas of counties throughout the United States. So just, for example, some USDA areas are Escalon, Ripon, Lockford, Valley Springs. Those areas, because of their density, because of their population, qualify for USDA. And USDA also allows 100% financing too. Now, in the Valley, as we know, prices are pretty high. So there are a lot of homes that no longer meet the conforming limit. So conforming versus jumbo, here in San Joaquin Valley, there is a disparity here. The maximum conforming loan amount is $766,550. So if your loan amount exceeds that amount here, you then have to go into what we call a jumbo loan. Now, a jumbo loan is a secondary loan that you can get. Generally, most big banks offer this type of financing, but the rules for jumbo loans are much more strict. You have to have a really good credit score. Sometimes you have to be able to verify your rent payments. And you always have to have payment reserves. Now, what are payment reserves? If your mortgage payment, say, is $3,000 a month, most jumbo lenders want you to have 12 months payments reserves after your down payment and after you close. So effectively, after you spend all that money, they still want to see $36,000 worth of reserve payments in order for you to qualify for that jumbo loan. So jumbo is a good product if that's the only product you have. If that's the only product available to you, you do try to see if there's other things out there to help you to avoid that, to make it easier. But jumbo financing is also a way to go for people that can't afford it and have the means to do so. And first-time home buyer, those are our friends. That's who we help the most, and that's who we love to help. I would say 80% of the transactions we do are with first-time home buyers. Again, we have a myriad of programs. Some offer as much as 5%, as much as 6% for down payment and closing. Some have gift functionalities to them, and some even have forgivable options if you keep the loans over a certain amount of time. Whatever the case may be, we will offer you everyone we think is feasible for your situation, and we will give you each worksheet so you can see the difference between each one. You can see the rate, the payment, and your cash to close, see how each one affects you, and mainly see which one fits your budget the best. Our job here is to give you options. We're not going to pigeonhole you into something and say, here, take this, okay? We're going to give you our advice and tell you what we think is best for you, but we're also going to give you the options to make your own decision. And in turn, to ask us questions about each one and how it pertains to you and which one we feel benefits you the best. Now, most of our loans, I'd say 95% of them, are fixed rate options, which means your principal and interest payment is fixed for the entire duration of the loan. It will never change. Okay, now, if you pay your taxes and if you pay your insurance with the payment, your payments can adjust over time. Why? because sometimes your hazard insurance, your property insurance goes up or down, depending on if you have no claims or if you have a fire in your house, okay? Property taxes, depending on valuations of homes, your property taxes can increase or can decrease year over year. So even though your payment is fixed, which it truly is, your principal and interest payment is fixed, your actual monthly payment, especially if you pay the impounds or the property taxes and insurance with the payment, they can adjust. So please be aware of that. Now, adjustable rate mortgages, in a market like this, adjustable rates become more popular. Why? Because generally the interest rates on adjustable rate mortgages are lower than the current 30-year fixed rates. So there are, people that have the money to do so and can afford the fluctuation of rates. They often look at these because they feel that in time, either rates are going to go down and they'll be able to convert that adjustable into a long-term fixed rate and secure a better payment down the road. However, it gives them a means to save more money now, as opposed to taking a higher fixed rate and paying more per month. Now, adjustable rates are very risky though. So if you can't stomach the roller coaster, we definitely advise you don't do them. So loan types, FHA. Again, FHA is the most popular loan out there. It is government insured. And the big misconception with FHA is people think that you have to be a first-time home buyer, and you don't. You can own a property on a conventional loan now and use FHA financing to go and buy your new home, for example. 3.5% down payment is the required down payment. You can put more if you like, but no matter how much you put down, even if you put down 20%, you'll always have to pay PMI on an FHA loan. That is the rule. I don't know why, but that's what the government says we have to do. There are rehab loans available. So if you find a house that is in good standing but just needs updating, you can also obtain what they call rehabilitation financing, where you can finance some of the improvements and, basically turn the house the way you want it and get the home you want and get your dream home all in one shot. So rehab loans are a very good option for you, especially if you're not that picky, or if the seller's willing to wait, because they do take a little longer, but you can give the opportunity to you to be able to rehabilitate the home the way you want. 100% gift funds are allowed. They do have to be verified, but they are allowed, which means that if you live paycheck to paycheck and your parents want to give you $20,000 to purchase a home, they can do so without any hassle. There's generally no cash reserves required to close as long as the system approves you. And most programs require you to have a minimum score of 620. However, on FHA loans, you can go as low as 500 with 10% down. Okay. So if you have a lot of money to put down, but maybe your credit score isn't the greatest, you still have an opportunity to get financing even under 620, as low as 500. Okay. Now, VA financing. Financing, again, is for military veterans and their spouse, either active duty or retired or discharged or disabledly discharged. It does offer 100% financing in most cases. Okay. And you don't have to be a first-time home buyer for VA. And the great news is there's no PMI. VA does charge what they call a funding fee, which is added to the front end of your mortgage. However, if the veteran is disabled over a certain percentage, then they don't have to pay the funding fee. And one of the other caveats to being a disabled vet is that you generally can get your taxes removed from your tax bill as well. In California, you can. And USDA also offers 100% financing. Again, this is in more rural areas, like Escalon, Ribbon, etc. You don't have to be a first-time home buyer on USDA. 100% gift is allowed. USDA also allows a score as low as 600. Our internal rule is 640, but we have sources that go to 600. And income limits do apply. So where FHA and VA have no income caps, USDA has a household limit. So there is a calculation that we have to use. Some people do not qualify for it because they make too much money, or their household size isn't big enough to support, what they're trying to do. So some people just won't qualify for it based on those factors. And USDA, out of all of these loans, has the strictest guidelines on any of them. Okay, so they have a thing called debt to income ratio. So your debt to income ratio generally on USDA cannot exceed 31% of your total monthly income, gross monthly, and 43% of between your mortgage and your credit card bills and your car payments. Okay, so they are the most stringent loan type out there. Down payment assistance programs. We've got a bunch. Spend all night talking about this. So the most popular one out of all these is Cal HFA. Cal HFA is reintroducing their Dream program, which we'll probably talk about somewhere in the slide in a little bit. But they do currently have the My Home that is active, and that's the most popular that they offer. Cal HFA rates are generally pretty good. Either they're at or below market in most cases. So its popularity is, is very big, and it's the most commonly one we use. We have other ones that like GSFA. GSFA is a great down payment assistance program because if you're somebody who wants to buy a 4-unit property and wants to reside in 1 unit and rent the other 3 out, GSFA will allow you to do so and give you down payment assistance as well. Smart Buy is another good program where it has expanded guidelines where it meets the FHA limits, which is great because it gives you the highest debt to income ratio out of all the programs out there. And you can also buy a 2-unit property with Smart Buy as well. Now, remember, you do have to live in it. And some of these other ones are more local based. AC Boost is Alameda County. House Keys is a below market housing program. City of San Francisco. So all of these other programs are more city and municipality based, but they all offer assistance to people who live or reside in those locales and help them get assistance as well. So, and there's even some that we have that aren't even on this list. So I always have Kenny out searching for, new programs that we can tie ourselves to, especially in the counties or the areas that we generally work, because we want to give people the most opportunity they can to become a homeowner. Smart Buy DPA. Now this one, as I talked about, has a forgivable option. So if you keep the loan for 5 years, the down payment assistance is totally forgiven, which means you don't have to pay it back. In a higher rate environment, that might be a little difficult, but you never know. So it does give you various assistance programs. It does allow you for 2 units, and the minimum FICO on this program is 620. Now remember, you do on any down payment assistance program, you have to occupy the property. Anybody that goes on the loan with you, they have to occupy the property as well. And then it also has the repayable option for the down payment assistance as well, to where the rates on this one are a little better because we checked them. You make this payment with your first mortgage payment, and the minimum credit score is 660, and it does give you up to 5%. So, you do get a little more assistance with this program than some of the others. Excuse me. And the closing cost assistance as well, as I just discussed. You can adjust the loan limits up to 5%. And again, it can reduce your cash to close. The one good thing about this program is that it has a pricing grid that allows us to go higher or lower on a rate as we need to. So say somebody, they make really good money, but they just spend their money constantly and it's very hard for them to save. We can increase the rate and reduce the cost of the loan out of pocket. So that way those people can still qualify and still be able to get into a home. That's the one beauty of this program, is it gives us the flexibility to make that adjustment. The other programs are kind of hard coded in the rates, where kind of what you see is what you get, and that's it. The link loan. So the link loan is kind of like a niche loan that we have, and it specializes in helping people who have untraditional income sources. They have only been at their job for, a couple of months and they were out of work for a year due to COVID or whatever. Or they're independent contractors that, just can't qualify for a regular loan. This is an opportunity for someone to get into a home, and even if they don't meet the normal loan criteria, still be able to, have a path to home ownership. This is kind of like, I would say, a bridge to home ownership. This is more of like a lease to own type situation. But the good news about the link loan is that every payment you make goes towards the equity of the house. That equity will be yours when you take that loan over. It doesn't go to the entity. You don't share it with anybody. It's your equity to keep. So this is good. This is also good for people that have what they call ITINs, or tax ID numbers. A lot of Hispanic families, one of the spouses has an ITIN and the other one has a social. Well, with this loan, they could do it with 3.5% down, and they can still find a way to get into a home. Now, what does it take to get a house and how to qualify for a loan? This is the fun part. So the top is always creditness, willing to repay. And, people don't understand how credit, really affects them. one simple credit card late can knock your score from 680 to 630. Okay. I had a lady today in my office, great example. She had a 655 credit score, and she was past due on a Best Buy account, and she wants to buy an investment property. And I told her, look, when you pay this account off, your score goes to 689. But I don't want to pay the $400. I shouldn't have to pay it. I'm like, okay, well, look, the interest rate difference was 6.99 to like 7.99 between the two credit scores. So just imagine 30 points in a credit score made one whole interest rate percent difference. That's how much credit affects you, especially when you purchase a home. So, like I tell people, was it really worth going to the bar and spending 50 bucks at the bar instead of paying your, Capital One credit card? No, it wasn't. Is it really worth going to Starbucks every day and getting, that, macchiato latte or whatever you get for, 10 bucks a day when you could have made that credit card payment? No, it's not. So if getting your house is your goal, you have to be disciplined and you have to look at your financial situation and say, what's really important? And once you make that decision to decide that owning a home is important, you'll make the sacrifice you need to do to make it happen. Now, income and employment, whoops, sorry, went too soon, my bad. Income and employment. So income and employment, validating income is extremely important in a mortgage transaction. We often ask you for, W-2s. We often ask you for pay stubs. My office always asks for year-end pay stubs because it shows us everything you made for the entire year. It breaks down your overtime, your bonus pay, shift differential, per diems. All that stuff can be calculated to your income. All that stuff can make a difference in how much you qualify for. And believe it or not, I've seen that final pay stubs year-end pay is sometimes actually even higher than what's on your W-2. So if a normal loan officer just asks you for your W-2 and say you made 72,000 on your W-2, and I say, no, I want to see your final pay stub, and your final pay stub says 76,000, we're using 76,000. That just gave you $4,000 more annual income, which could boost your home price from 425 to 450. And now you got a 3-bedroom, 2-bath instead of a 3-bedroom, 1.5. So we try to really look at income from a very dissective perspective. We ask for a lot of income items, but the reason we do that is because we want to make sure, especially when we're really fighting for someone to approve at the maximum amount, that we could squeeze every dollar we can out for them. Okay, and assets. So I'm going to tell you this. Cash is the worst thing to have in a mortgage transaction. Okay, if you have cash on hand, you might as well just put it in the bank and let it sit for a couple months because we cannot account for it. We don't know where it comes from. Any funds used for a home purchase have to be accounted for. We have to be able to trace it. So because cash is untraceable, we can't use it. But what we can use are 401k accounts. We can use Robinhood or stock accounts. Obviously we can use your checking and savings accounts, and we can use gift funds from parents. We can use gift funds from, your nieces, your nephews, your uncles, your aunts. Okay, so all those can derive assets, which can all help you use that money for down payment and closing and help you get into a home. And lastly, property appraisal. Okay, so people often get confused on what an inspection is and what an appraisal is. Okay, when you purchase a home and you obtain a home inspection, that is your document, your packet to know exactly what's wrong with the house. It's like a Carfax for a home, basically. Okay, an appraisal, a property appraisal, is for us, the bank. It helps us determine the value of the home and if the home is habitable for you to move in. Because if it's not, and it doesn't meet the guidelines of the lending, Fannie Mae or Freddie Mac, then the seller or somebody has to make the house up to code. So a bank's not gonna lend money if they consider the property to be deficient, okay? Because at that point it becomes a risk and they could lose substantial money if the property is in bad shape. So an appraisal is just as important as the other items, because if the valuation is not there for the price that's offered, or if the property is in poor condition, you may not be able to get that one. And FICO scores, how FICO scores are calculated. So the percentages here are fairly accurate. Obviously, payment history is very important. Length of credit is great. So when people file bankruptcy, I always tell them the first thing you want to do as soon as you get out of your bankruptcy is to get a credit card, possibly two. Whether it's secured or not, who cares? duration of time and length of credit is extremely important in your credit score. I filed bankruptcy in 2007. I've had the two same credit cards since then, and I've never closed them. I never use them, but they're still there. Why? Because I've had them for 16 years, and that tenureship helps my credit score, and I'll never close them. Okay. Amount owed, 30%. So generally, you always want to stay under 30% of your balance. So if your credit limit. So if your credit limit, say $1,000, you always, to get your optimal credit score, you want to try to keep your balances $300 or lower. And in use or new credit, so things like inquiries, buying a new car last month, that's going to drop your score at least 20 points immediately. Okay. So anytime you get new credit, your score is going to drop because it's a new account and it hasn't cycled through yet. But each payment you make, you'll see that your credit score will gradually increase over time because that credit is starting to get aged and it's starting to, it's starting to make a difference in your FICO. Okay, now qualifying for a loan. Of course, credit's important. Minimum 600 on most programs, actually it's 580, but depending on where you're at, we'll tell you where you need to be at. We do have tools that gauge your credit score and what you can do to improve it. A lot of times people we talk to say, well, I'm working on my credit, and my comment to them was, are you a credit expert? Well, no. Okay, well, we've done this a long time. Let us help you improve your credit score without having to pay for credit repair, without having to spend thousands of dollars on something that sometimes doesn't even benefit you and it's a waste of money. Spend $45 with us. We'll make up a game plan for you, even if you're not ready now, but we'll help you get there, and we'll help you get there the right way and not waste your money. Okay, no open judgments or tax liens. That does have a very big effect on your credit report, on your ability to purchase too. So if you do have judgments or tax liens, most time they have to be paid. Okay, sometimes if you have payment arrangements, they will be allowed, but more often than not, they do have to be paid in full. Okay, and one line of open active credit in the last 12 months, that's generally a rule of thumb. However, we have been able to get people approved with credit only 6 months old. So generally, as long as you have a credit score, in most cases than not, you're able to get financed. A great example, cousin Stevie. He came to my office. He had absolutely zero credit. So he went and got on a credit card. He didn't have a score on any bureaus. He went and got a credit card. Came back, 3 or 4 months later, Ernie? Yeah. He was at 660, boom. Perfect for Cal HFA, and that's how we got in. Yeah. So it only took him a couple months. Yeah. And it wasn't that his credit was horrible. Yeah, good credit. It's just he didn't have any active credit at all. So when people say, like, oh, I'm going to pay off all my bills and close my accounts, no, that's the worst thing to do. Like, you have to have, in order to have a credit score, you have to have open active trade lines. Okay. So you always want to keep at least one credit card open. Always. Now, specific waiting periods for derogatory events. Foreclosures, generally 3 years. Short sales, 3 years, and bankruptcy, generally 2 years. But after these timeframes are passed, you're generally able to get into and purchase a home. Okay, and here are the rules for each particular loan program. So as you can see, on a conventional loan, foreclosure 7 years, FHA 3, VA 2. So VA has the most, if you look at the slides here, VA has the most leniency out of all the programs. 2 years, 2 years, 2 years, and 1 year after bankruptcy, after 13. FHA is the next lenient, but conventional is obviously the hardest. So just because you file bankruptcy, as I tell people all the time, and some people I've just had to tell them that their credit's been so damaged over the years that it's just, hey, bite the bullet, spend the $1,000 or $1,500 to start over. Because why would you want to sit there and pay $10,000 towards all this bad debt that after you pay it off is going to do absolutely zero to help your credit score? You're better off saving that money and filing bankruptcy and starting fresh and keeping that money to rebuild your credit. And so that way you'll be able to start building a fund. So that way, when your 2 years are up, you can buy a house and you'll have the means to do so. So the one thing I hate people doing is spending good money on bad credit. Like, that's the worst you can do. And that's why I always tell people, like, if you're unsure about what you're doing, have us look at it first, please. And how much damage do mistakes on my score make? Well, here's a great example. You can see how much a max out credit score costs you, how much a 30-day late payment costs you, how much debt settlements cost you. So yeah, you definitely don't want to try to settle debt. Keep paying if you can. Foreclosures and bankruptcy. So all of these have a negative effect on your credit score. So again, it's very important to maintain it, and sometimes you really have to make those sacrifices to keep this credit score pristine. Okay. Now, some things you can do to improve your credit. You can review your report annually. Freecreditreport.com gives you a free credit report every year, or you can pay us $45. We'll run a tri-merge for you. We'll also analyze it to see if where there improvements are that you can make to make it better. Obviously, paying your bills on time, very important. Sorry, my throat's a little dry. I've been talking all day. Again, keep revolving ratios 30% or lower. Generally 10 to 20% is optimal. So, stay away from your credit limit because that hurts you a lot. And keep a good mix of credit. So revolving and installments. So revolving credit is things like credit cards, Macy's, Dillard's, Capital One, Visa, MasterCard. Those are all revolving accounts. Installment loans are car payments, finance companies where you go and get a short-term loan to pay off your debt. Those are all installment loans. Installment loans or installment accounts have an end date. So those are accounts that are set up to be paid off at a certain time. As for revolving accounts, are open-ended. So in our experience, having a mix is good, but it's always generally, if you have to pick one or the other, you always want to pick the revolving account over the installment account. And don't close unused accounts. Again, keeping open credit is good. The more open trade lines you have that are active, the better your FICO is going to be. And minimize inquiries from when necessary. Car lots are infamous for putting a bunch of inquiries on your credit report when you buy a car. So, that does not help your score, but only apply for credit when you absolutely have to. Not just like, oh my God, I'm going to save 10% at Victoria's Secret if I apply for this card. Is it really worth it? It may not be, because that 5% score drop could make your score go from 700 to 695. And you may not be able to qualify for that interest rate you thought you were going to get, or even the loan program you thought you were going to get. So keep that in mind. And if shopping for a loan, focus on a 2 or 3 week period. So we generally do a soft pull, so it doesn't affect your credit score. Some places don't mandate you do a hard pull, but you do want to do it within a couple of weeks of each other, because credit scores do change, and I've actually seen them change from week to week. So, don't be surprised if you have your credit ran by another place and the score is a little different, because it is very common for it to happen. And use your credit sparingly and wisely. Right? Don't live off your credit. Okay. Only use it when you absolutely have to. Try to use it when you can use it and pay it off. Activity on your credit cards is also a very good way to build up your credit score. They do monitor a date of last activity. So the more active that they see it, the more better your FICO is going to be. And now let's talk about income and employment. Now, 2 years of employment are required. So we must be able to validate 2 years of working history. Some exceptions are if you go to school. Say you're going to school to be a dentist, and you get your degree in May and you get a job offer in June. You don't have to wait. We'll take your job offer letter, we'll take your transcripts, and that'll qualify you. But in most cases, we do have to see continual work history. Now, some gaps are allowed. We have to be able to document them and explain them. You don't have to work at the same job for 2 years, okay? You can switch jobs in a 2-year period and still be eligible. If you started a new job last week, it's still possible for you to get financed. We just have to see how your offer letter looks and be able to document how you get paid. If we can quantitate that you're going to get 40 hours a week and we can get it in writing guaranteed, then we can count your full pay. However, if there's no guarantee and your hours vary, we may have to, wait a little bit longer and see what those averages are to be able to calculate your income. But that doesn't mean you can't buy. It just means you might have to wait a little bit. Self-employment. So people that are self-employed have the hardest time purchasing. Why? Because being self-employed is the best tax savings that you can have, because most business owners shelter all their money so that way they don't have to pay a lot of the IRS. However, when it comes to buying a home, it often hurts you, because even though you may have made $200,000 in gross income last year, After all your write-offs, your net income is only $10,000. And guess what? We're not going to count 200,000. We're going to count 10,000. So when you go to apply for the traditional loan, it's really going to hurt yourself when you do that as a self-employed borrower. Now, the good news if you're self-employed is that we do have programs that allow you to put a minimum of 10% down if you are self-employed, where we use bank statements or we use your 1099s or use other means to validate your receipts. Okay, so there is hope for you if you are a self-employed borrower. However, to get a traditional loan, it may be a little more challenging. In most cases, you do have to have 2 years of validated tax returns and an active listing, a profit and loss, and a balance sheet. So please keep that in mind as well if you own a business. Okay. Now, debt ratios. Okay. Debt ratios are very important in the lending industry because each program has their own debt ratio limits and their own guidelines. Okay. So if you look at the slide here, it says Mr. and Mrs. Smith make $120,000 a year with a $700,000, $700 a month car payment. Their sales price is $350, loan amount is $332,500, down payment of 5% at a 30-year fixed rate of 6.25%. So their principal and interest payment, it shows here, property taxes $292, insurance $62, MI, which is private mortgage insurance or MIP, gives you principal, interest, tax, insurance payment of $2619, which is 26% of your monthly income. That is called your housing ratio. Okay, so your housing ratio is what we call your front end ratio, and that's what your total house payment, the percentage of your house payment encompasses based on your income. Now, when you add the car, it gives you a total of 3319, which is 33.19%, which is your back end ratio. Your back end ratio consists of not only your house payment, but all your accountable debts as well. That includes student loans, car payments, credit cards, yeah, and installment loans. Okay, and that's how your back end is derived. So under this circumstance, the Smith family can pretty much qualify for any loan out there. However, again, FHA they allow your back end ratio to go up to 56.99%. VA, if you're retired, I've seen even as go as high as 66%. So the government loans, in most cases, give you more flexibility and more buying power than a conventional loan can. Not always, but in many cases it does. Now, also qualifying for a loan with assets. So again, whenever we're using assets, any type of assets, we must be able to verify down payment, closing costs, and reserve requirements depending on the program, especially if you're getting a jumbo loan. Now, what those consist of are checking, savings, stocks, and mutual funds, which you talked about, 401k loans, or some type of fund that you have at work, deferred comp works. If you work, say, like at Tracy Defense Depot, you can use your TSP. And gift funds from family members are allowed. And again, gifts, you must be able to validate them, and we must paper trail them all. We'll need a bank statement in most cases, a signed gift letter by all parties, and the account, and the funds must be sent from the account that's on the gift letter. So you can't say, okay, okay, Donnie, I'm going to give you $5,000 from my PNC bank account, and then we get the check and it's from a Chase account. That's not going to work. So everything has to match up whenever a gift's done. And then qualifying for a loan on the property. Your appraisal must be equal to or greater than the purchase price. So if it's not, then that's up to your agents, or that's up to you agents to negotiate with the seller or to negotiate with the buyer to figure out if you can find a happy ground or not. In some cases, agreements can be come to and the middle ground can be met. Some cases, the deal's canceled. So it really just depends on how all parties come together to try to make the transaction work. And again, if it's property's financed, it must be in good habitable condition. So it can't be shoddy, the roof can't be torn off, can't have a bunch of holes in the floor. All that will not allow it to pass the appraisal process, and you'll be required to either have them repaired, or you may have to end the transaction as a whole, or do a different type of loan like a renovation loan. And certain loans require very specific property conditions, like VA loans. Adequate heating, safe water supply, adequate roofing, crawl spaces, and safe access from the street. And this is pretty much the normal with all loans, not even just VA, but FHA and conventional too. As you can see, FHA loans requires health and safety items, lot graded away from the house, handrails for all stairways, which is that's definitely called an appraisal repair. on appraisal report, a roof in good condition. They also require smoke detectors in every room, carbon monoxide detectors by gas. Okay, now, how do we start the approval? Well, we can share a link with you. We can take your application now. But before you even start searching for a home, you always want to get pre-approved. You want to know how much you can qualify for. You want to know what your estimated monthly payment's going to be, what the estimated interest rate's going to be, and how much this all is going to cost you. All this is stuff you need to know and should know before you even start looking for a home. After that's done and we pre-approve you, then you go and find a home. So you work with your realtor, your buyer's agent. They'll give you a list of homes that meet the criteria that you want within the price range in which we approved you, and that's how you start your home search. Once you get into contract, or what we call escrow, you sign and return your initial disclosures as quickly as possible to prevent any delays. Those disclosures are by us, and then your agent, and then your realtors or agents will also have disclosures for you too. Part of the processing of the loan is we have to get an insurance quote. So we'll need to contact your insurance agent to get that. We'll have to order things like verifications of employment. So we'll need, direct contacts to your employer to be able to obtain this information. We'll order your appraisal and inspection. So again, we'll order the appraisal because that pertains to us, the bank. You've already set up the means to negotiate your inspections and to have your inspections done as a buyer. So in most cases, you do a home inspection. So sometimes there's other inspections done too, but that's totally up to you, whatever else you decide to do. But in any transaction, any transaction there's financing, an appraisal has to be done. Underwriting. So this is generally the hardest part of the transaction. The underwriter is the person who approves or denies your loan. They make a risk assessment based on the information provided and ask for additional documentation after approval so they can finalize the loan to make sure it's compliant with the loan program in which you are applying for. And final approval and closing disclosures. So before we close, you will get what they call a final closing disclosure, which will show you the breakdown of all the fees, the entire fees in the transaction, and who pays what, what's allocated to you, what's allocated to the seller, and how much you need to bring to close. And once you review that and you're okay with it and sign it, then hopefully in 3 days, you'll be able to sign, close, and fund. And then you get your keys. Hooray! Now, after the loan receipt, final loan approval, the documents will be prepared. You'll get a copy to keep. And there will be your first payment letter. That's where you make your first payment to. And it'll have all the information you need regarding your loan. And again, once your CD's out, you have to wait three business days, including Saturday, before you're eligible to sign. So the CD waiting period allows you to, investigate the fees, to make sure they're all valid, to ask your loan officer questions, to ask your realtor questions, and to do your homework to make sure that everything you understood that was going to happen happened in this process, so you can move forward with your transaction. And that's the finish line, and you get your keys and a bottle of champagne. So what's next? Well, we got to see if you qualify and, make sure that you're creditworthy and you have the documentation in which to do so. You always want to get pre-approved first, always. Don't waste a realtor's time if you haven't got pre-approved. Honestly, it's not a cool thing to do. They spend money on gas, they take time away from their family. Show them the respect they deserve and at least get pre-approved before you try to make them show you 20 houses in one day. Start shopping for a neighborhood. Shop for homes in the area you like or that you can afford. Keep your loan officer in the loop always. Now, we are very big on that. So the agents that I work with and that I like to work with are very communicative with us. We work as a team. We are your team. So our job is to work in cohesion to make sure that we offer at the right price, we ask for the right things in the transaction, and that I call the listing agent to tell them how wonderful you are as a buyer and why they should take your offer. And trust me, I do that on every transaction that I handle. And then that hopefully gives us the opportunity to close your loan. And it gives me the opportunity to call you and tell you, congratulations, you're now a homeowner. And enjoy your home with your family and friends. And of course, if you have any questions, you can always contact me. Best available by text, usually always. Email's great, phone calls, you'll either get me or Kenny if I'm not available. But we're always here to help and answer any questions. And there are no dumb questions, trust me. Whatever question you may think is dumb, it probably might be the most important one of the whole transaction. So I always tell people, if you have a list of questions, just send them in an email, put them 1 through 10. And I'll respond under each number. So that way chronologically you can keep it. If you and your wife or you and your spouse have questions, let's set up a group chat or a group text so we can always revert back to it. Having the communication documented is very, very important. Of course, we're going to talk on the phone. Of course, we're going to conversate, but the important stuff needs to be via text or some sort of verbiage that is kept. So that way you can keep track of what's said, nothing gets misconstrued, and the process goes as best as possible for you. And that's it. Thank you very much for your time. Peace, y'all. See you in Vegas.